All right, welcome everybody. Another episode here of the Hampshire Capital Podcast / webcast video program. Shane Carter with me as always, Eddie Austin. How we doing, Eddie?
Man, I'm doing great today. You know, I got a little information earlier today and I decided to come into, let's talk about debt, loans, stuff like that. So a friend of mine called me, we're very active in the market. And he said, hey, Eddie, I just want to give you a little bit of information. U.S. Treasury bonds now went up to 4.4%. And with that, I said, okay, well, how does that translate to us? And he said, well, you guys are a preferred borrower, so it's a little bit different. But for a brand new guy coming into space, he's going to pay about a 6.5% on a Fannie product or a Freddie product. And then, preferred borrower, meaning someone's active, they have a built relationship with Fannie and Freddie, you might qualify for as low as a 5.8, 5.6%. And, with us, we really lean hard on them loan assumptions. Some of these past properties, we've secured debt at a very attractable loan assumption.
Very.
For a long term.
For a long term.
It hasn't affected any of our deals, and even going forward, we're still looking for loan assumptions. So I just thought it would be a really good time to talk about and educate our audience on the different types of debt. A couple years ago, bridge debt was the hot topic. Everybody was trying to secure bridge debt. And there's also been a ton of conversation around rate caps, rate locks, and stuff like that, and how people wish they'd have bought them. I even know people that made money when they sold their rate cap because the amount went up.
Oh yeah, sure. So yeah, let's dig into the debt topic. Let's to define some of the major buckets that we look at in our industry, which are you mentioned bridge debt. The term bridge is really sort of like a bridge, right? It's to get you from here to here. And so the point of that debt is usually taken on by, mostly value add investors that are going to take and buy an asset at a given price point and NOI. They're going to execute a value add program, inject CapEx. And so that bridge debt gets them from either a destabilized position, let's say they're less than 90% occupied or less than 85% occupied or something, where the agencies, which we'll talk about next, can't really put agency debt on it because it's not at the right occupancy level, hasn't been there for a period of 90 days or more, or there are other extenuating circumstances on the asset that preclude it from being able to go into that more stabilized debt product. So a bridge product gets you from a destabilized asset or an asset with a value add program into a stabilized asset with a rise in the interest rate and sort of rise in the NOI, I should say. Your bridge debt products are going to be more expensive. They're going to carry a higher spread over SOFR or over the 10-year T or whatever they're basing it off of. And that spread is really just how many basis points over the base rate is that lending institution going to charge for investing in that particular risk profile of that asset.
Mm-hmm.
And so,
and also,
yep.
It seems like the most common bridge component to a loan type used to be a bridge to HUD, because HUD took such a long time to secure.
Sure, 9 to 12 months. Yeah.
And so it seemed like the most common was a bridge to HUD. And now we're seeing more of a bridge to agency. Mm-hmm. So people really started to use that debt product.
Yeah, although I actually like the HUD product.
How do you do?
I think it has some people view it as some negative connotations relative to the minimum CapEx and sort of having to keep your property a certain way. Look, we want to keep our property that way anyway. So to me, that's not a negative. That's just par for the course. That's what we're trying to do anyway. Little known fact about some of the HUD debt products too. Unlike agencies, did you know, Eddie, that a HUD debt product, let's say you get a HUD debt today and let's say it's 6%, just for ease of communication, right? And that same agency, let's say you also can get a Fannie Freddie or agency product at 6%. Well, let's say it's a 5-year term on the agencies At any point during that term, you look up in 2 years, 3 years, 3.5 years, if interest rates have gone down to the point where you can now get new interest rate debt for, call it 4% or 4.5%, you can't change your agency debt, but you can change your HUD debt.
Really?
Beautiful, right? You can apply and say, you get that rate reduction program, and you can apply to have that 6% HUD rate drop to what the prevailing rate is at that moment of that day. And you can lock that in, let's say at a 4.5%, even if it's only 2 years down the road. And then you stay in that same amortization time period, you stay in the same other general provisions in terms of the HUD product, but you can actually lower your rate in a HUD product. It's amazing. That's something that a lot of people don't know.
Yeah, and also with a HUD, you can go a lot longer term too.
That's right, 35-year. Yes, that's right. And so back to the bridge product. So what is a bridge product? People talk about debt funds and things like that. They're pretty much the same thing, right? A debt fund is a pooling together or allocation of capital for a specific purpose in either a REIT or a mortgage REIT or some other type of vehicle that is set up to pool and aggregate capital and lend it out for an arbitrage. And that's the purpose of it. And so that there's a lot of capital that likes to replicate and steadily increase by going on that in that way, because it's the safest part of the stack, right? You got your primary debt, and you got your mezz debt and pref equity. Let's say they kind of go hand in hand in that sort of second tier, and then you got your JV or LP equity. And then your GP equity is sort of furthest down and at most risk. So, if you're at the first part of that stack in the primary debt piece, you're the safest and you're getting a lower yield accordingly, right? That's why you're only getting 4, 5, 6% on your money because you're safe. You're generally your debt service constrained, right? So the loan to value that you're going at is going to be debt service constrained. And in a higher interest rate environment, that generally means you're going to be at a lower loan to value. So you have a lower ratio of debt to relative asset value, even safer position to be in.
Yep, absolutely. So let's talk about agency debt. And before the end of this, let's talk about those rate caps and rate locks. So
sure.
Agency debt.
Yeah, agency debt, there's sort of the quasi-public or public-private entity, Fannie Mae and Freddie Mac. They're similar in terms of their protocols and their mandates, but they're different agencies, and they kind of compete for each other for business. Even though, again, they still have the overarching thesis of providing affordable interest in debt capital for affordable workforce and other housing in the United States, which most of our assets fall under that purview, right? Of providing quality, affordable housing for folks, which is a basic human right, basic human need. So the agencies, we could go on a wormhole on each one of these, right? We're we're just covering top level, but in general, they're backed. They have a little bit better rates and terms, generally speaking, than your debt funds or your bridge debt product. And again, it's because they're selecting a safer profile. And that safer profile is in a stabilized asset, has to be 90% occupied or greater for more than 90 days. It's relatively, a low crime area or not too much crime, shall we say. There's a general upkeep in appearance and standard, not quite as stringent as HUD, but oftentimes much certainly more stringent than bridge and debt funds, right? And then again, there's still debt service constrained, and there's still a loan to value parameter there. But the beauty of the agency products is that they're assumable. So if, like we've experienced, let's say somebody locked in an interest rate in late 2020 or 2021, and then they went and sold that asset in 22 or later in 21, that debt was assumable. And, we as the buyer, any new buyers, were able to assume that debt under its given terms and given thresholds, and generally speaking, we've been able to carry that forward. For the most part, bridge and debt funds, they'll do that if they feel it's in their best interest. But for the most part, that doesn't happen. There's sort of new debt that just gets placed on it at that point. And so, there's a lot of security in a Fannie Freddie product. The terms are fixed. Oftentimes the yield maintenance or prepayment penalties are sort of fixed and pre-agreed to. And you can buy those down. You can change that sort of yield maintenance or prepayment out from a 5-year down to a 3-year or down to a 2-year. And so there's just associated risk with that, similar to a rate cap, which is something that you would absolutely likely purchase if you're doing a bridge product or debt fund product. So what is a rate cap? A rate cap is essentially a ceiling that you're buying for your interest rate. So let's say you get a debt product that's at 6% today, go back to our example, and let's say the lender requires you to buy a 2% rate cap. So that means that, so now you're buying this cap that says, okay, you're at 6% now, you're buying a 2% rate cap. That means you've got additional risk between 6 and 8%, but once interest rates hit 8% or greater, there's no more risk to you, and you start getting paid any delta above that. So if interest rates suddenly went to, 8.5 or 9 or 10%, you still would be fixing your rate at that 8%, and so your interest rate is essentially capped at that rate cap, and that's basically how they work. And the cost of them has gone through the roof in this environment because of the volatility and because of the risk of that future hedge. Now today, I'm personally in the camp of, look, our interest rate's going to go higher. Maybe if they go up another 50 bips from here, that's probably it. Will they go down? Well, yes. Yeah. Interest rates go up and then interest rates go down. Go look back in history. That's exactly what happens time and time again. They go up, they go down. They go up, they go down. They never stay down forever and they never stay up forever. It's just the way it is. So I like the, going with like a Freddie float or some type of product like that, where there's a forward hedge into lowering interest rate environments, right? And so you still have to buy a rate cap, but you can negotiate buying a pretty high rate cap at this point, and then really allowing what if your interest rate payments went down every month because the interest rates that the floor that they were based off, let's say SOFR, right? What if SOFR started going down and your interest rates started going down accordingly, but meanwhile you underwrote for them to stay the same? Now you've got that additional conservative arbitrage in your interest rate environment, and you've hedged by placing a rate cap on it so that it still won't go up. I like that play going into this environment, because you have the potential to make that lowering interest rate arbitrage as time goes on, 12, 18, 24 months from now.
Mm-hmm. Absolutely. That's that under promise, over deliver.
Yes, exactly. And then, you mentioned a rate lock. That's really in the process of applying for a loan, whether it's HUD, whether it's, agency, Fannie, Freddie, and usually also similar for a debt fund or for bridge debt as well. There's a time window in there where you can kind of lock that rate in, and then usually it's a 30-day, and you have to kind of close within that 30 days. But you can sort of watch that, and you can kind of watch it on an hourly basis. A good debt broker will do that for you, and when it's suddenly drops and you can pick up a couple basis points or 10 basis points, let's say, man, you lock that quick. And now you're locked in, even if you haven't closed that loan yet, you're locked in at that rate. And so if that rate goes up over the next 3 weeks, let's say, you're still locked in at that lower rate.
Right. Now, I would tell anyone underwriting a deal right now, if you are that tight on a couple little basis points or something like that, that's a lot of risk.
Oh yeah, no. You're just doing that as a course of pragmatic business, but yeah, you're right. You're underwriting, a couple basis points really shouldn't matter in terms of your deal and how it performs and underwrites. But you still pick up those little nickels when you can.
Oh, absolutely. Yeah, for sure.
Yeah.
But just a safe bet and with what you should do. So again, all our listeners out there, if there's anything else you want us to do, anything more on, go a little bit deeper on the subject. We didn't get to talk on institutional money that much. That's okay. I'm going to save that for another one because you can really go into that on the rabbit hole. But, first and foremost.
Oh, man, we could have gone into each one of these in a rabbit hole, right? We really covered top level. We can kind of dig into each one of these on a future level and talk about, commercial mortgage-backed securities and how does that whole system work and how does that structured finance work. But I think we covered a good enough top level for today.
Absolutely. Y'all have a great day, and thank you so much for the time, Shane.
All righty. Thank you. We'll see you on the next one.